Hi guys, this is Sebonga from Millionaire's Journey. We are continuing with our trading course, and I'm very excited because I'm getting the feedbacks. People are learning and people are making progress. The beginners now know the basic concepts, and they have a clear idea on what is forex and all these concepts that we've been talking about. So we talked about, today we are continuing. Yesterday we talked about what is a candlestick, advantages of using candlesticks, disadvantages of using candlesticks, and top candlestick patterns. So today we will be continuing to talk about the types of candlesticks. We will also talk about what do they mean. So we'll talk about types of candlesticks, we'll talk about what do these candlesticks mean, and talk about on the chart where to look for these candlesticks, and we'll talk a bit about the reliability of these candlestick patterns. So let's continue. So, are candlestick reliable? Candlestick pattern reliable? Not all candlestick patterns work equally well. So, not all candlestick patterns work equally well. Some candlestick don't work well. Some they work. Their huge popularity has lowered reliability because they've been analyzed by hedge funds. So their popularity, they are well known, has lowered their reliability because they've been analyzed by hedge funds. These well-funded players rely on lightning speed execution to trade against retail traders and traditional fund managers who execute technical analysis strategies found in popular texts. So hedge funds work against us. They work against us. Remember, we are retail traders. So these hedge funders, they don't mind to wait for the market to form a certain candlestick pattern, and then they trade against it to trap the retail traders and traditional fund managers. So they know what we are looking for as people who use technical analysis, or as traders who use technical analysis strategies. They know that we are looking for this candlestick, we are looking for this level, and they can manipulate, they can work against us, they can just trade against us and push the market to the opposite direction of that pattern. So hedge fund managers use software to trap participants looking for high odds bullish or bearish outcomes. So they trap you. They wait for the market to give you a pattern, and then they trap you. They use softwares to trap you. So when the market forms a buy candlestick, they do not mind to trade against that buy candlestick and then trap buyers in that trade. So they wait for people to buy and buy and buy, and then they trade against that order or that candlestick, and then you see the market just collapsing and selling down. However, reliable patterns continue to appear, allowing for short and long-term profit. So they do appear. What you can do as a trader is to try to trade them with proper risk management. With proper risk management, you can make money out of forex. The trick here is to win less, is to win more and lose less. You can win more and lose less. So if you get a chance to catch that good trade, just run with it. And if you get a chance to catch that candlestick pattern, just stay in and make sure that if they trap you, you lose less. Always use a stop loss. We talked about stop loss, I think 2 weeks back or last week. So just a little bit reminder, this is a candlestick, this is a high, this is a low, this is a open, and this is the close. A red one is for a sell, and the green candlestick is for a buy. Same thing, high, close, open, low. Bullish candlestick and bearish candlestick. By bullish candlestick we mean bulls, we are going up, and bearish we mean bears, we are going down. So let's continue and see this candlestick, how they look and what do they mean. So here are few easy to recognize candlestick patterns. Here are easy to recognize patterns. They only work within the limitation of a chart being reviewed, whether intraday, daily, weekly, or monthly. So this candlestick, they work when you check them on the chart. If you see it on the chart, just know it will work. Despite of the time frame, you can see it on a monthly, it will work. You can see it on the weekly, it will work. As long as it's not manipulated, it will work. So we have a doji, we have a engulfing pattern, bullish and bearish, we have a hammer, we have a shooting star, and we have a evening star. There are lots of candlesticks. These are the top 5 that I use, and I recognize them easily. So you will also know how to recognize these candlesticks as time goes. So the doji comes in 3 forms. We have a gravestone doji, we have a cross doji, and then we have a dragonfly doji. I will show you the examples. And then the engulfing pattern, there's bulls, and then there's bears. See here I said bullish and bearish. And then the hammer, it can be like this, it's for bears. A shooting star, it's for the bulls, and then the evening star is for the bears. So this candlestick, they can appear however they want. This one is the example of a bullish engulfing pattern. We have a bearish engulfing pattern. So you see the difference here. The green one is bigger than the red one, and then on the bearish, the red one is bigger than the green one. And then we have a bullish hamare. The green one, it's bigger than the red one, but we are looking for sells. And then we have a bearish, a bearish hamal. The red one is big and the green one is smaller, but we are looking to go to the upside. And then we have the dark cloud. The dark cloud is when the green candlesticks are coming, and then we have this one bigger candlestick, and we are looking for a market to reverse and start going down. We have the rising sun. This is the opposite of the dark cloud, and we are looking to go down. And then we have a morning star, the opposite of the evening star. So morning star, the market is pushing down, and then we have this small candlestick followed by a green candlestick, and we are looking for the buy side. And the exact opposite happens on the evening star. And then we have a pin, bar, or a hammer. So it can either be a hammer if it's like this, it can be a hammer if it's the opposite of this, it can be a hammer, a shooting star. So it's when the market comes down, and then we have this balancing it, and now we are looking for the change in the direction. And then we have a dragonfly doji. I talked about it here. A dragonfly doji is when the market is coming, and then it shows us this, and then we are looking for it to reverse. We have a gravestone, the exact opposite. The price is coming like this, and then we are expecting it to turn. And then we have this shooting star. The price comes like this, and we have a candlestick that is shooting, and then we are expecting it to reverse. And then we have the bullish tweezers, where the market is coming down, and we have these two candlestick balancing it, and we're expecting it to push to the upside. And then we have this, the bearish tweezers, the same opposite of bullish tweezers. And then we have the bearish Marubozu, and it's like two candlestick equal size, but the difference that the market was going up, the buyers were in control, and then the sellers came and they took over. So now things are 50-50, they are equal, and we are expecting the market to push down, as you can see, the opposite of the bearish Marubozu. So these are the candlestick. I will post them so that you can do a further research on them. I will post them in our Google Classroom, and you can do a further research on them. So in this video, I will only be explaining the doji, the bearish and bullish engulfing, the hammer, the shooting star, and the evening star. So let's continue. So let's talk about the dojis. We have three types of dojis, as I mentioned earlier. We have a dragonfly doji, a doji cross, and a gravestone doji. The pattern type, the doji pattern type, it's a reversal or continuation pattern. I will explain it when we look at the examples. Dojis are unusually very short candlestick compared to other candlesticks. So dojis are very short, and they can be tiny on the chart. Let's look at the dragonfly. What happens here is the open, the close, and the high are all the same price, but the price did attempt a low and wasn't able to do so. So the open and the close are same, but the price did try to go down, but it came back to close on the same level. This can tell us that the market failed to sell. The market failed. It's looking to go up. So this means this period of indecision, or some would say period of agreement between bears and bulls, the price is fair, at least for that time being. So let's look at the cross doji. This shows us an open and close that are identical, but there was a decent high and low during the time period, and price ended up closing at the open price. This is very similar to a dragonfly. The fact that the price moved around a bit, not both directions, before closing where it started. So this pattern can mean both. Remember I said the dragonfly can mean that we are pushing up. The cross doji can mean that we can push up or we can go down. And then the last doji is the gravestone. This candlestick opened, made a nice high, and then came back down and closed at the open price. This is the opposite of the dragonfly doji. The fact that the high wasn't sustained is actually a little bearish. The other fact is that the open and close were the same, which is a bit bullish. So let's look at these candlesticks. Here is the example of a dragonfly. This is a dragonfly, and this is a gravestone. We will look at this on the charts, and you will get to see them, right? And then we have a long-legged doji. As you can see, this was the open, and then it went high, it went low. And then there are a dragonfly, gravestone, And then we have a 4 price doji, where the open, the low, and the high were the same thing. It's just one thing. So where do we look for this candlestick? Where do we look for a dragonfly? Where do we look for a gravestone? Where do we look for a doji cross? So look for a dragonfly doji on upward trend line, entry points to go long. So if the market is on the upper trend, is doing like this, you can look for a dragonfly here to continue pushing up. Look for gravestone on a downward trend line, entry point to go short. So if the market is dropping like this and doing this, you can look for a gravestone here to go short, sell. Look for doji cross on both downward or upward trend line, entry points to go short or go long. So you remember I said this one it's indecision, so you can look for it on both levels. You can get it. It can mean a buy or it can mean a sell, right? So let us continue, and then let's look at the engulfing. The engulfing is the bullish. We have a bullish and a bearish patterns. The pattern type is a reversal. These two patterns are characterized by two candlestick that completely engulfs and or covers the first one. So bullish engulfing formation, the green candlestick opens below the previous close and then closes above the previous one. So the green candlestick completely covers the red candlestick. Bullish engulfing pattern, the green candlestick opens below the previous one and close above. So it opens below. You see, we have this candlestick, the price opened below it, it opened above it. This is for a sell. It opened above it and then it closed below it. This is a good example of the engulfing. I will explain it. This demonstrates a change in sentiment. So if the market was doing this and this pattern forms, the market will start dropping, and if it's dropping and this pattern forms, the market can start going up. Keys to identifying the engulfing pattern: look at the length of the second candlestick to see if it's longer than the first candlestick, and does this length engulfs the length of the first candlestick. So if the length of the candlestick covers the previous candlestick, we have the engulfing pattern. Check to see if the second candlestick has a body length that is at least greater than the body of the first candlestick. So if the body of the first candlestick is bigger than the body of the previous candlestick, it means we have this pattern. Where to look for this pattern? Look for a bullish engulfing pattern on the upward trend line entry points. So you can look for a bullish to buy on the upward trend line to buy, and you look for bearish on the downward trend line to sell. A bearish engulfing formation is the exact opposite of the bullish engulfing pattern. So let's explain this in example. So we have the market that is pushing up, then it forms this candle, but the problem now comes when these candles open high and then close below. It shows that now the sellers are stronger than buyers, and we are expecting the price to start going the opposite direction. Same applies when the price was going down, and then we have a bigger opposite candlestick forming, and we are expecting the price to start pushing up. So we have a bullish engulfing and a bearish engulfing pattern. See, this candlestick is smaller than this, we're expecting price to start dropping. We're expecting the price to start giving us a sell trades. So let's check other patterns, and then let's look at the hammer and the shooting star. The hammer and the shooting star. This is a reversal type pattern. A hammer is a price pattern in a candlestick charting that occurs when the currency trades significantly low than its open and relies within the period near the close price. So this means the price opened and it pushed lower, it went lower, but it came back to close almost where it opened. These patterns formed a hammer shaped candlestick in which the lower shadow is at least twice the size of the real body. A shooting star is the exact opposite of a bullish hammer. Alright, so this is the hammer, and this is the hammer, and this is the shooting star. A shooting star is a bearish candlestick with a long upper shadow or no lower shadow, and a small real body near the low of the body. So a shooting star has a long wick and it doesn't have a body. It has the wick is longer than the body. A shooting star is a type of a candlestick that forms when a currency open advances significantly but closes the day near the open again. Look for hammer on a upward trend line to go long. So if the price is doing this, you can look for hammer here to push up. Look for a shooting star on a downward trending to go low. Trend line to enter short. So here is the hammer. This one is an inverted hammer, and this one is a shooting star. The price was pushing up, the inverted hammer formed, and the price started it's likely to start dropping. And then we have price pushing up and the shooting star formed, and we're expecting it to drop. Same thing here and here. Here is a clear example of the hammer. You see that the price is dropping, then the hammer forms and it starts building momentum to the upside. So we can try to use these candlesticks to be profitable traders, but you will see them clearly when I make a video showing the example of these candlesticks. Let's look at the evening star and the morning star. An evening star is a currency chart pattern used by technical analysts to detect when a trend is about to reverse. It is a bearish candlestick pattern consisting of three candles: a large white candlestick, a small bodied candlestick, and a red candlestick, indicating a selling trade opportunity. And for a buying opportunity is the exact opposite. Look for evening star on a downward trend line to go short. Look for morning star on an upward trend line to go long. Morning star is the exact opposite of the evening star. So here is a morning star pattern. We have the market that is dropping, right? And then we have this first candlestick, and then we have this small, and then we have the close above this one, and then we are looking to start pushing to the upside. And then the evening star is the exact opposite. We have this market going up, and then we have this candlestick and this, and then we are looking to start selling. So these candlestick formations can be profitable, but sometimes they can take a long time to form and sometimes you may not even see them because they won't be as clear as they are on the examples. And then we have a triple candlestick patterns. We have a morning star, we have an evening star, we have a morning doji star, we have an evening doji star, we have a bullish abundant baby and a bearish abundant baby. These are 3 stars candlestick. So if you see this, we are expecting a push up, and this one we're expecting a sell, and this one is a push up, it's expecting a sell. We are expecting a push up, expecting a sell. 3 white soldiers. This shows that the momentum is strong and we can look for buys. And 3 black crows. The momentum is strong to the downside. We are looking for selling opportunities. And a bearish 3 line strike. So we have a bearish 3 line strike. We can expect the market to continue pushing up, and we have a bullish 3 line strike, and we can expect the market to start pushing down. So on this video there was a lot of information about candlesticks, and I will post more on our Google Classroom. And please learn and ask questions where you don't understand. Thank you for watching up to this very end. We will meet again on the next video where I will be explaining or showing you examples on the chart. Thank you.